Welcome back to Investing Talk podcast. Today, we're taking a closer look at AST SpaceMobile, a company really pushing the envelope in satellite communications. The big question, the one a lot of people are asking, and what we're focusing on is AST SpaceMobile a good time to buy right now? We've pulled together a lot of information for you, financials, technical charts, industry news, the whole nine yards. Our goal is to help you, sift through it all, figure out what really matters, and give you the tools to decide if this high-flying company fits your own investment approach. And hey, before we get into all the fascinating details, if you find these discussions useful, please do subscribe, like us, maybe leave a comment. It honestly helps us out a lot. And if you're feeling extra supportive, you could consider buying us a coffee. It helps fuel these analyses. Okay, let's get into it. Our listener, and probably many of you, are curious about AST SpaceMobile. So starting from the top, what's the basic idea? What are they actually trying to do?
Well, what's really interesting, I think, is that AST SpaceMobile isn't just, another satellite company. They're building what they call the first ever space-based cellular broadband network. And the key part is it's meant to connect directly with standard smartphones, your normal phone. That really puts them right at the cutting edge of potentially a huge shift in how we all communicate globally.
So just to clarify, this isn't like satellite internet where you need a special dish on your roof or some kind of dongle. My phone could just connect.
That's precisely the idea. Their unique value proposition, the thing that makes them totally different, is aiming for that direct satellite link to completely unmodified smartphones. That really separates them from competitors like, say, SpaceX's Starlink, which definitely needs those special terminals. And they've already shown it can work. They did successful 5G calls, got data speeds up to about 14 millikeys with their test satellite, Blue Walker 3. It's pretty solid proof of concept.
14 megs from space directly to a phone. Wow. That does sound like a potential game changer. But I guess building something that huge, they can't be doing it alone, right? Who are they partnering with? Any big names?
That's a really important piece of the puzzle. They have managed to secure strategic partnerships with some huge global telecom players. We're talking AT&T, Verizon, Vodafone, Rakuten, major operators. And these aren't just like handshake agreements. Many involve significant prepayment commitments, even equity investments. We're talking over $135 million combined. So that kind of backing, it doesn't just validate the tech, it also hints at real revenue streams once they get things properly up and running.
Okay, so revolutionary tech, big partners. Sounds good. But, I mean, launching satellites, building this network that has to cost an absolute fortune. What do the current financials actually tell us, especially for a company that's still, pre-commercial, burning cash to build?
Well, yeah, their revenue right now really reflects that pre-commercial stage. It's minimal. In Q1 2025, they reported revenue of $718,000. Now, that was up 44% from Q1 the year before, which sounds okay. But quarterly revenue has been really up and down. It actually dropped over 60% from the previous quarter, Q4 2024, which was $1.9 million.
Yeah.
So their trailing 12-month revenue is sitting around $4.6 million, which, for a company valued over $16 billion, it's tiny. Really highlights how early stage this is commercially.
Tony is right. So what about profit? Are they making any money yet, or is it all investment right now?
No, definitely not profitable yet, which, again, is pretty standard for this kind of build-out phase. They posted a net loss of $45.7 million in Q1 2025. That works out to an EPS of -$0.20, although that loss was actually better than what analysts were expecting, which is closer to -$0.26. So a slight beat there. Their operating expenses were about $63.7 million just in that quarter. Mostly engineering costs around $27 million, and then general admin stuff, another $18 million or so. It just costs a lot to develop and deploy this kind of global satellite system.
$63 million in a quarter. Yeah, that's serious spending just to keep the lights on and the rockets launching. How are they funding all this? Do they have enough cash?
Actually, they've got a surprisingly strong balance sheet right now. As of the end of March 2025, they reported $873.8 million in cash and equivalents. It's a big step up from the $565 million they had at the end of 2024. Gives them a much healthier cushion. And they have very little debt, only about $17.6 million. So that leaves them with a net cash position of roughly $856 million. Now, based on their current quarterly cash burn rate, which is about $28.5 million, that $856 million gives them roughly 7.6 years of runway, which is frankly quite impressive for a company spending this heavily on growth.
7.5 years. Okay, that's a decent runway for now. But given the scale, I mean, launching a whole constellation, are they looking for more money? Oh, absolutely. They need more cash down the line. They recently set up something kind of $500 million at the market, or ATM equity facility. That was back in May 2025. Basically, it lets them sell new shares directly into the market over time, raising cash when they need it. It's flexible. But the downside is it means potential dilution for current shareholders, right? Selling more, stock spreads, ownership thinner. So to try and minimize that, management says they're also actively chasing non-dilutive funding, money that doesn't involve selling more stock. Think loans, grants, that sort of thing. And they've already secured $550 million in commitments from places like the U.S. Export-Import Bank, these quasi-governmental groups. That kind of funding is often more stable, maybe cheaper, and critically less dilutive than just constantly selling shares. It's a big deal for them.
Okay, so huge plans, big spending, but a decent cash pile and access to more funding, both dilutive and potentially non-dilutive. But let's circle back to that valuation. Given the minimal revenue, how does the market justify valuing this company so highly right now? Right, the valuation is where things get, let's say, extreme. It's a really important point because they're essentially pre-revenue. AST SpaceMobile trades at some eye-watering multiples. Take the price-to-sales ratio. Based on that trailing 12-month revenue of $4.6 million, it's, wait for it, 3,554x.
3,500.
Yes. I mean, it's astronomical. It tells you the market isn't valuing the company based on today's business at all. It's pricing in a scenario where ASTS completely changes global communications, a sort of winner-takes-most outcome, maybe like how people valued early internet companies. It's not a traditional valuation metric at this point. And their price-to-book ratio is 21.5x. Compare that to the average telecom company at 1.2x, or even other satellite players around 7.2x. It's way higher. PE ratio, of course, is negative because they're losing money, which, as we said, is normal for now.
Wow, okay. 3,554 price to sales. Those numbers are definitely stretched, to put it mildly. What's the main message investors should take from that?
The clear message is that the stock price is almost entirely built on hope and future potential, not on current financial performance. Investors are making a huge bet on massive growth and eventual profitability, driven by this unique technology. But even with these crazy numbers, it's interesting that the average analyst price target is still around $42.91. The range is wide, from $30 up to $64, but it shows that at least some analysts believe the future growth could justify even these levels, or perhaps higher ones eventually. There's some support there, despite the metrics.
Okay, so we've got the big idea, the tricky financials, the sky-high valuation. Let's talk about the stock chart itself. The price has been on an absolute tear recently. What does the technical picture tell us? Is this momentum sustainable?
It really has been explosive. The stock is up, 132% just this year, and it hit a new 52-week high recently at $50.41. Right now, it's trading way above all its key moving averages. The 20-day average is down near 33.3s, the 50-day near $28, the 200-day near $26. When a stock is so far above these averages, it usually signals a very strong bullish trend. Momentum is clearly positive.
Strong trend, definitely. But can a stock keep going up that fast forever? Are there any warning signs? Maybe it's getting a bit overheated.
That's exactly the concern. The technicals are screaming overbought. Look at the 14-day RSI, the Relative Strength Index. It's at 85.6.
And anything over 70 is usually considered overbought.
Right. So 85.6 is deep into severely overbought territory. It suggests the buying has been maybe too aggressive lately, and the stochastic per K indicator is also way up at 95.4, which basically confirms the same thing. Extremely overbought. Now, this doesn't guarantee a crash, but it often suggests the stock might need to pull back or at least consolidate just to catch its breath. And you have to remember, this stock is incredibly volatile. Its 30-day annualized volatility is 81.5%. That's huge. Plus, its beta is 2.02, meaning on average it moves about twice as much as the overall market, both up and down. So if the market hiccups, this stock could really feel it.
Okay, super volatile, technically overbought. What are the key price levels people should keep an eye on then? Support and resistance.
Well, for immediate support, you'd be looking around $45.94, and then below that, maybe $44.35. These are areas where buyers might potentially step back in if the price dips. On the upside, the main resistance is just that recent high, $50.41. That's the level it needs to break through to continue this run immediately.
Moving beyond the charts, what about recent news? Anything significant happening that's feeding into this investor excitement or maybe concern?
There have been several key developments this year that have definitely boosted sentiment. Big one was joining the Russell 1000 index at the end of June. That's a major milestone, puts them in the big leagues, attracts more institutional investors. They also nailed down access to 45 megahertz of crucial lower mid-band spectrum here in the U.S. and Canada. That was through a deal with Legato Networks, really important for their service rollout.
Right, spectrum is key. And wasn't there something about India too? How's that progressing?
Good memory. Yes, they announced a partnership with Vodafone Idea to bring their service to India. Huge potential market. But that one seems to be hitting some regulatory snags right now. It's a good reminder that rolling this out globally involves navigating complex regulations in each country, which can be a hurdle.
Okay, so positive news like the index inclusion and spectrum, but also potential bumps like the India situation. How are the Wall Street analysts reacting to all this, especially after the big stock run?
It's definitely a mixed bag from analysts right now, which kind of reflects the whole situation, high potential versus high valuation and risk. For example, Scotiabank recently downgraded the stock. They went from sector outperform down to sector perform, basically neutral, setting a price target of $45.40. Their reasoning was pretty much just valuation thens. They felt the stock price ran up too much, too fast. It got ahead of itself.
But not everyone agrees.
No. On the other hand, you have B. Riley. They actually raised their price target up to $34 from $36, and they kept their buy rating. So the overall consensus, if you average out the 6 analysts covering it, is still technically a buy, with an average target price of $42.91. But clearly, there's disagreement on whether the current price is justified.
Interesting split. What about insiders? Are company executives buying or selling shares? That can sometimes give a clue.
Looking at the last 3 months, insider activity has actually been negative. Corporate insiders have sold about $3.2 million worth of shares. The chief operating officer was among those selling. Now, it's important to note, sometimes these sales are just pre-planned, maybe related to stock options expiring or tax planning. Not always a direct signal of lost faith. But still, net selling by insiders is generally something investors pay attention to. It's another data point in the mix.
Okay, so bringing this all together, the tech, the financials, the market action, the news, what's next? What are the really big things on the horizon, the catalysts that could push the stock one way or the other?
There are some absolutely critical near-term catalysts coming up, really in the next 6 to 12 months. First big one. The first commercial Block 2 Bluebird satellite, supposed to ship out very soon, Q2 2025, and then launch in July 2025 from India. That's a massive step towards actual service.
The first real commercial one.
Exactly. And tied to that, management is forecasting a big jump in revenue, $50 to $75 million for the second half of this year, 2025, as they start turning on services. Then there's the regulatory side. Getting full approval from the FCC here in the U.S. for widespread commercial service is key. That's pending. Plus, they have contracts for 5 more satellite launches lined up over the next, say, 6 to 9 months. They're planning to launch roughly every month or two. Successfully executing these launches is absolutely vital to building out the network.
Wow, that's a packed schedule for the next year, launching satellites almost monthly. What about looking further out, say, the next 1 to 3 years? What are the longer-term goals?
The longer-term picture involves scaling up significantly. Initial commercial services with those big partners like AT&T and Vodafone are expected to really start rolling out in 2026. That's when the revenue model should hopefully start proving itself. There's also potential to expand into government work. Think Department of Defense contracts, maybe tapping into programs like Golden Dome. That could be another big revenue stream. And just more global expansion. Maybe a formal joint venture in Europe with Vodafone, signing up more partners in other regions. The big goal is to have a constellation of over 60 satellites up by 2026, providing continuous coverage in their key markets. That would be a truly functional global network.
60 satellites by 2026. That's incredibly ambitious. It sounds amazing if they can pull it off. But surely with something this complex, especially involving space, there must be major risks too, right? What could go wrong?
Oh, absolutely. The risks are substantial. It's crucial to understand them. First, there's huge execution risk. AST SpaceMobile has to actually build and launch dozens of these complex satellites successfully, on time, and within budget. Any failures or major delays could be disastrous.
Manufacturing and launch?
Yeah.
Tricky stuff.
Then there's technology risk. I mean, the core tech, while demonstrated, is still largely unproven at full commercial scale.
Yeah.
What if the satellites don't perform as expected? What if there are unforeseen issues? Regulatory risk is another big one. We call the hiccup in India. They need approvals in numerous countries to operate globally, and getting those isn't always straightforward or guaranteed. And finally, competition. They're not alone. SpaceX with Starlink is moving fast. Amazon's Project Kuiper is coming. Yeah. Other players too. It's getting crowded.
Okay, so operational risks are clear. What about the financial side and market risks, beyond just launching satellites?
Financially, the big one is dilution risk. Remember that $500 million ATM facility. If they can't secure enough of that non-dilutive funding, they'll have to sell more stock, which waters down existing shareholders' stakes. And they need a lot more capital. Estimates are around $1.3 billion just to get those first 60 satellites launched. So they absolutely need to raise significant additional funds somehow. There's also revenue uncertainty. That $50–75 million forecast for later this year, it's aggressive. If launches slip or regulatory approvals get delayed, they might miss that target, which could hurt the stock.
And market risks.
Well, the valuation risk we talked about is huge. With multiples this high, there's simply no room for error. Any stumble could lead to a sharp correction. The extreme volatility is also a risk in itself. That beta over 2 means it can swing wildly. If the overall market turns sour, highly volatile stocks like this often get hit hardest. And lastly, there's sector risk. The whole satellite communication space could face headwinds, regulatory changes, spectrum fights, maybe even some disruptive new technology emerging.
Okay, so putting it all together, the incredible potential, the big partners, but also the sky-high valuation, the execution hurdles, the funding needs, the volatility. What's the bottom line for our listener wondering if now's the time to jump in?
I think the overall picture for AST SpaceMobile is clearly high risk, high reward. The potential is genuinely transformative, the technology is unique, the partnerships are impressive, those are big pluses. But the valuation is extreme right now, the execution risks are very real, and the technical charts look overbought. So caution is definitely warranted at this specific moment.
So if someone is interested but maybe hesitant at this price level, what's a potential strategy? Wait for a pullback.
Given the current price around $50.20, yeah, the stock looks stretched. Those technical indicators, the recent downgrade, it suggests a consolidation or pullback might be coming. An optimal entry range might be somewhere between $35 and $42. If you're more conservative, maybe wait and see if it pulls back to the $35–$30 area. That's a solid 20–25% drop from here, offering a much better risk-reward setup. If you're more aggressive, maybe look at the $40–$42 rates, which is closer to where the analyst consensus target sits. Still a discount from today, but less of a wait.
And thinking about time frame, is this something you buy and hold for years, or is it more of a short-term play given the volatility?
Given how long it takes to build and launch a satellite constellation and then ramp up commercial services, this really feels like a longer-term story. You're probably looking at a 3 to 5 year horizon, at least, to see if the fundamental story truly plays out. Trying to trade it short-term with this kind of volatility and all the binary event risks, like launch success failure, that's really challenging, very risky. If someone does decide to trade it, using a stop loss is crucial, maybe something like $42 to $45, which is 15–20% below the current price, acknowledging that high volatility. For potential profit targets, maybe $55–$60 short-term if the momentum continues, or looking further out, $65–$75 medium-term if things go well.
And last question. For someone building a diversified portfolio, how much exposure would make sense for a stock like this?
Given the high risk, the volatility, the frankly binary nature of whether this succeeds massively or potentially struggles, position sizing should be conservative. I'd suggest limiting it to maybe 1% to 3% of your total portfolio value. You don't want something this speculative to dominate your returns either way. I think the really unique thing to consider here isn't just the moonshot tech, but how they've tried to de-risk it with those big partnerships and prepayments. That structure makes it a bit different from other pure spec plays. You have to weigh the tech and their funding strategy.
Okay, this has been a really thorough look at AST SpaceMobile. Fascinating stuff. It definitely offers you exposure to potentially world-changing technology in satellite communications. Imagine your phone working anywhere. But as we've really dug into, the current valuation is incredibly high, and the technicals suggest it might be wise to wait for a better entry point right now. For long-term investors who can stomach significant risk, there might be real value here, but likely at lower prices than today. For anyone thinking short-term, extreme caution is needed due to the volatility and that recent huge run-up. What really stands out to you after this whole discussion is that long-term dream worth navigating all these near-term hurdles and that eye-watering valuation. Definitely gives us all a lot to think about. We hope this analysis has helped you cut through some of the hype and feel more informed about AST SpaceMobile. Until next time, keep learning, keep growing.